Think about where all the money is coming from. Do you realize that there is no value behind the currency currently in circulation? Welcome to Avant Vie. In today's video, we're going to take you through how the Federal Reserve manages and controls the circulation of money. So stick to the video, keep watching, and let's dive in. Introduction. A few decades ago, all-use money was backed by gold. That is, if things got really bad, anyone who had a piece of printed paper money could, in theory, exchange it at the Central Reserve for the same amount of gold. Makes sense. At least on paper, the world's money supply was backed by solid gold, which was a strong base. The Federal Reserve, simply known as the Fed, is the United States central banking system. It was established on December 23, 1913, the day before Christmas Eve, with the passage of the Federal Reserve Act. Following a succession of financial panics, especially the Panic of 1907, prompted the desire for centralized management of the monetary system to ease financial crises. Events such as the Great Depression in the 1930s and the Great Recession in the 2000s have contributed to the increase of the Federal Reserve System's powers and responsibilities over time. Function. The impact of the Fed on banking and the economy has grown over time. It carries out 5 general tasks to advance the well-being of the American economy and, more broadly, the public interest. They include: the Fed conducts monetary policy in the United States to promote maximum employment, stable prices, and moderate long-term interest rates. Also, the Fed promotes financial system stability and seeks to minimize and contain systemic risks through active monitoring and engagement in the United States and abroad. The Fed regulates individual financial institutions' safety and soundness and monitors their impact on the financial system as a whole. The Fed supports the safety and efficiency of the payment and settlement system by providing services to the banking industry and the U.S. government that make transactions and payments in U.S. dollars easier. Lastly, they promote consumer protection and community development through consumer-focused supervision and examination, research and analysis of emerging consumer issues and trends, community economic development activities, and consumer law and regulation administration. The Fed's structure. The Federal Reserve System is made up of a 7-person board of directors in Washington, D.C., and 12 regional banks, each of which is run by its board of directors. The commercial banks in their areas own these regional institutions. They only do business with the Treasury and their member banks, not with the general public. They don't lend money for cars or houses, and their biggest assets are U.S. government bonds, such as Treasury bonds. The Federal Reserve banks also do many things for other banks, like process checks and store and pass out cash. The Federal Reserve keeps an eye on and regulates all banks, whether they are national or state banks. The system is run by the Federal Reserve Board of Governors. 6 of the governors are chosen by the president for 14-year terms, and the board's chair is chosen for a 4-year term. However, the president and chair do not serve at the same time. The current chair is Jerome Powell. How the U.S. handles central banks. The people who made the Federal Reserve Act didn't want there to be a single central bank. Instead, they set up a central banking system with 3 important parts. 1. A central governing board. 2. A decentralized operating structure with 12 reserve banks. And 3. A mix of public and private features. Even though some parts of the Federal Reserve System are similar to private sector organizations in some ways, the Federal Reserve was set up to help the public. The Federal Reserve System is made up of the Board of Governors, the Federal Reserve Banks, also called Reserve Banks, and the Federal Open Market Committee, FOMC. Together, these 3 organizations make decisions to help keep the U.S. economy healthy and the financial system stable. Executive Board. The Board of Governors in Washington, D.C. runs the system. The Board of Governors is the national Fed body. The board consists of 7 governors picked by the president and confirmed by the Senate. Spread out 14-year periods ensure stability and continuity. The chairman and vice chairman serve 4-year terms and can be re-elected. The Board of Governors and the Federal Reserve banks and branches share several responsibilities. The Board of Governors guides monetary policy, analyzes the U.S. and global economic and financial situations, and leads committees that investigate consumer banking regulations and electronic commerce. The board monitors the financial services business, enforces consumer protection legislation, and oversees the payment system. The board oversees reserve banks. It approves presidents and board members. The board sets how much banks require in reserves and approves reserve banks' discount rate changes. The board's most essential task is to participate in the FOMC, which sets monetary policy. The FOMC has 7 governors who have the majority vote and 5 reserve bank presidents. Monetary policy tools have grown over time. As a governmental agency, the board answers to Congress. Members of the board testify before Congress and communicate with other agencies. The Fed chairman briefs Congress twice a year on monetary policy, testifies on other subjects, and meets with the Treasury Secretary. Even while it speaks with the executive branch in Congress, the Fed makes its own choices. Instead of Congress, the board charges the Federal Reserve banks. An accounting company and the GAO audit its financial reports annually. Federal Reserve Bank. The Board of Governors is in charge of 12 Federal Reserve banks and 24 branches. Reserve banks are the operations of the central bank. Each of the 12 reserve banks serves its region, and all but 3 have other offices in their districts to help depository institutions and the public. The banks are based in the cities of Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. The Fed indirectly helps banks, the government, and the public. Reserve banks are where cash and coins are kept and where checks and electronic payments are processed. Regional commercial banks are supervised by the reserve banks. Reserve banks make payments to the Treasury, sell government bonds, and help with managing cash and making investments. Reserve banks look into issues that are local, national, and international. Research gives policymakers a broad view of the economy and helps reserve bank presidents who attend FOMC meetings. The district bank is run by the board of each reserve bank. These directors have business experience in the area, are involved in the community, and are leaders. The board gives the Fed ideas from the private sector. With the approval from the Board of Governors, each board picks the president and first vice president of the reserve bank. The member banks own shares of the reserve bank and get dividends. Banks can't sell or trade Fed stock, but shareholders in public corporations can do either. Reserve banks connect directly with banks in their districts through exams and financial services. This helps the Federal Reserve System do its job because it brings regional perspectives to the table. How is money controlled? There are 3 ways that the Federal Reserve System controls the amount of money. 1. Reserve ratios. Banks are required to keep a portion of their deposits as a reserve against possible withdrawals. The Fed controls the amount of money in circulation by varying this amount, known as the reserve ratio. For example, suppose it orders banks to keep an extra 1% of their deposits. They would then have 1% less of money to lend. 1% may not seem like much, but it translates into billions of dollars being taken out of the economy. 2. Discount rate. When banks temporarily take on more than they can handle, they sometimes have to borrow money from the Fed to meet their reserve requirements. The discount rate is the interest rate on these loans, and it also affects the amount of money in circulation. If the Fed raises the discount rate, banks won't be able to borrow as much as they used to and will have to stop lending money and raise their interest rates. Because of this, less money is put into the economy. On the other hand, if the Fed lowers its discount rate, banks have more money to give to their customers. From this point of view, the discount rate has a snowball effect. If it goes up, other interest rates also go up. And if everything else stays the same, economic activity slows down. If it goes down, the opposite happens. 3. Open market operations. Open market operations. The Fed's open market operation, in which it buys and sells government securities, are by far the most important thing it does. After Congress approves an increase in the national debt, the Treasury Department makes a mix of bonds and bills and notes that it auctions off to private dealers who are allowed to trade government securities. The Fed buys or sells these assets through its Federal Open Market Committee, FOMC, or open market desk when it wants to change how the economy works. If the Fed wants to make more money available, its open market manager will buy back Treasury securities from private dealers and pay for them by putting money into their bank accounts. It does not send any real money. This ability sets it apart from other financial institutions and gives it power. The banks of the dealers now have more money to lend, and some of these loans end up in other banks, which gives some of them to other borrowers. As money spreads through the economy, the Fed's first purchase has a multiplier effect. When the Fed sells some of its securities, the process goes back because the price is taken out of the accounts of the buyers. This means that the buyers' banks have less money in their accounts. The main idea is that changes in the money supply are caused by the Fed's accounting tricks, not by turning on and off the printing presses. The Fed and politics. Whether or not the Fed is seen as part of a theory about who rules, like pluralism or the power elite, depends on how politically independent the system is. On paper, the Federal Reserve System seems to be mostly independent, since it gets its money to run from the banks that are part of it and not from Congress, and because its governors can't be fired by the president. Because governors' terms are so long, a president can't choose a majority of them. The Fed also meets behind closed doors and does not have to report to the executive branch. Under these circumstances, it might not have to answer to the public. Congress set up the Fed and is very interested in how it works. It can change the Fed's charter at any time. The Fed's officers talk with top officials from the Treasury Department, the Office of Management and Budget, OMB, and other agencies every day. The chair talks to legislative committees and asks the president's staff for advice. All of the board members know how important it is to have support on both ends of Pennsylvania Avenue because political opposition can hurt their programs. In short, the fact that the Federal Reserve is independent by law doesn't keep it out of politics. Conclusion. In short, making fiscal policy seems to fit the pluralist view of American politics, while making monetary policy seem to fit the power elite model. But before we accept either of these ideas, we need to see how the public as a whole affects things. That's it for today. Don't forget to give this video a like and subscribe to our channel. Thanks for watching, and we'll see you on the next one.